On the podcast with us today is Kyle Hetherington, and we're looking forward to diving into a property that he acquired recently called Perry Place Apartments. It's 70 units right outside of Richmond, Virginia, and Manchester, Virginia there. Well, Kyle, welcome to the podcast. Before we dive into this, let's go ahead and have you give the listeners a little bit of a background about yourself and kind of how you got into this multifamily side of things.
Sure. First off, thanks for having me. I'd say my background probably isn't too unique. It's unique in one regard, in that I've been in it since I graduated from school, and I've been doing it ever since. But the unique aspect about it is I've seemed to, not by plan, progressively get smaller and smaller with the firms that I've been associated with. Started off my career at the Carlyle Group, actually not even involved in real estate on the corporate private equity side of things. But all my prior experience had been in the real estate space, and subsequently parlayed that into a role at Greystar, who obviously we all know is an 800-pound gorilla in the industry. Spent a couple of years there on their acquisition team, covering the Midwest over to the Northeast down through the Mid-Atlantic. I'm from Maryland and still live here, so to an extent knew most of those markets pretty well off the bat. Spent a couple of years there. Obviously had lots of transaction volume and plenty of experience, and then went over to another shop from there with some of my prior work colleagues, where I spent a few more years focused specifically in the multifamily space. That was, again, focused a somewhat different geographic footprint from kind of Boston through the Carolinas, where over the last 3 years before starting up our firm, we acquired about 18 properties, somewhere around 500 million assets under management. And then, got the itch to do my own thing. It's hard to have experience like that and not want to do your own thing. Especially in the multifamily space, where, the barriers to entry are relatively low in my opinion, but the upside is there if you're willing to work hard and you know what you're doing. So we started our company, Fulton Street Partners, in July of this past summer, and we've closed on this deal that we're obviously talking about, Perry Place, and have another one under contract and hopefully a third here shortly.
Well, it must be challenging to start a business in the middle of COVID-19, isn't it?
It was, and on top of that, I had my first son, my first kid, on March 14th, about a day before the whole world flipped upside down. So it was interesting from a lot of aspects, but I like to think about it as being bullish when others are bearish, and it's come to fruition so far. So.
Let's dive into this Perry Place Apartments here, 70 units. Talk to us first about how you found the deal.
Sure. So, it was technically an off-market deal. I do the air quotes because off-market seems to be a bit of a faux pas these days, and you never know truly how many people have eyes on the property. But it was through CBRE, a group that I obviously, with my prior firms, had plenty of experience with, and they knew what we were doing with our new firm and generally what we were looking for. So we kept in close contact with them, and it was fortunately struck a good luck for us, coming across this deal when we did. Part of our overall thesis of our company is, with myself and my two partners, Jack Cottrell and Charlie Garner, being able to move fast and having boots on the ground in all the markets that we intend to invest in. And so it was kind of right time, right place for us, where we came across the deal. We were able to wrap our heads around it quickly, get on site within the week, and put a compelling offer in front of the seller.
So going back to, the broker for a minute here, what was that conversation like? Because obviously you went from, working for somebody else to now actually working on your own, right? And having your own business. So what was that conversation like with the broker?
To an extent, it was, there's obviously always going to be the question when you're the new firm on the block, what your experience is, where your capital is coming from. You're obviously, sellers are always concerned about surety of close, etc. To an extent, we leaned on our prior backgrounds. All three of us come from institutional backgrounds. My partner Charlie was at Cushman & Wakefield prior to Fulton Street, and my other partner Jack was at various investment banks, including Wells Fargo and their mergers and acquisitions group prior to joining us. And so, that helped to an extent, essentially convincing them we know what we're doing. But on the other hand, this was a particular seller that had already lined up a 1031 exchange with the sale proceeds of this deal and was intent on closing within a certain time frame that in our mind limited the buyer pool, especially from some of the more institutional players that have a little bit more of a bureaucratic process. And we were able to wrap our heads around it quickly and get it done. So we pitched that when they first reached out to us, and it was, for lack of a better term, first mover's advantage for us.
So how many rounds of offers in this particular deal did you go through did you got to the point of kind of best and final, or was it really not like that kind of a process where you had like a best and final because it was really kind of like only you, if you will, offering on this property?
Exactly. So it wasn't your typical marketed process where it's initial round and best and final and whatnot. We submitted our initial offer contingent upon a handful of items, like the PCA, ESA, clean title, etc. Had our opportunity from our initial LOI to do some limited due diligence that fortunately the seller was amenable to get ourselves comfortable with where our initial offer was. And then, between initial LOI and when we were awarded the deal, it was probably about a 2-week period. So it was a little bit of a unique process, versus your typical marketed assets. But,
What was the purchase price on this asset?
It was 11.4 million. It's just over 160 a door.
Okay. So 11.4 million, 160 per door. What kind of a seller was this? Was it an institutional level seller, or was it more like a mom and pop?
A very institutional seller. So whether you want to include this on the podcast or not, I'm sure they'd be okay with it. But the seller was Capital Square 1031, who's also based out of Maryland.
Is that a DST sponsor?
Sorry?
Is that a DST sponsor?
Yes, that's right. Yep. And so, they're extremely active throughout the Mid-Atlantic, but our understanding was at the time of them marketing this deal, they had a bit of a program to continue to expand further into the Southeast and kind of first half of the Sun Belt. And they had identified some opportunities, which they'd like the 1031 sale proceeds from Perry Place too. So, that was a great process, and we can't thank the brokers enough, for their involvement in the process in terms of, getting us up to speed, or getting the seller up to speed on our platform and who we are and our ability to close and, operate at an institutional level throughout the entire due diligence and closing periods.
So where does your equity come from when you're acquiring an asset like this? Is it more institutional, so that's your level of experience, or is it also from private investors?
Sure. So it's a bit of a two-pronged thing for us, depending on deal size, market, timing, a wide variety of factors. Our general approach and goal is to privately syndicate each of our deals on the LP side. So generally we'll target a 90-10 or 95-5 structure with our partners, and then we'll go out for the equity slug and reach out to high net worth individuals, family offices, friends and family, etc. With where we're at right now as a company, and our ability to continue to take down deals as frequently as we would like to. You can only go to the well so many times with your investor base from a syndication standpoint. So as those deals get larger, which we're looking at plenty of them, it necessitates to an extent the need for a programmatic JV partner, which we've been successful in doing. At the end of the day, it's getting your name in front of as many people as possible. There's plenty of demand out there right now for multifamily, specifically in the value add and opportunistic space. Depending, the short answer is depending on deal size, it kind of determines the way we go about capitalizing the project.
Sure. So what was that conversation like though with that seller, obviously being an institutional kind of by the book type of a seller and in that institutional space? What was that conversation like with them when you're trying to quote unquote sell yourself as the buyer, especially being your first asset that you've acquired since starting this company?
Sure. So like I mentioned earlier, the biggest thing from the seller's point of view is surety close in my mind. And so an avenue we took to get the comfortable seller with that was providing a backstop guarantee on any fundraising shortfalls on our front. Fortunately, we didn't have any. But in the event that we did, we were contractually obligated through a high net worth investor of ours that would backstop the remainder of the equity check. So fortunately, we had the connection to be able to represent that to the seller. But the goal from the get-go was to privately syndicate the entire check.
Now, when you had that conversation with the seller, was that contract presented to them so they actually had verification that was in place?
They did, yes.
So they wanted to see that on this particular deal, if for some reason there's a gap that needs to be filled, then this high net worth investor is going to come in and just take that slice.
That's right. We did that through a verification of funds on our end to get the comfortable seller or the seller comfortable.
And in doing that, did you have to give up a larger piece of the GP or acquisition fees or whatever other kind of splits you might have to that high net worth investor to kind of motivate him to want to do that?
Yeah, so this particular investor participated on the GP side with us as a co-investor. It wasn't necessarily something that we were opposed to, especially starting off. You got to be pretty creative with your general deal structure just to get some deals under your belt. Fortunately, this is a strong enough opportunity where it's creative enough to the point where it wasn't going to hurt us to do something like that. We had to get creative, but made it happen.
So in your initial kind of process of submitting your LOI and getting to the point of actually getting it awarded and then eventually the PSA, at what point during the entire process did you actually physically tour the property?
Yeah, so we had the broker initially reached out to us with the deal. I think it was late in the week at some point, probably a Thursday or a Friday. So, hey, listen, we've got this off-market opportunity coming through. It's on a short fuse. We need someone that can wrap their arms around it quickly and put together a compelling offer in short order. We spent the weekend digging into the deal as much as possible. And if I'm remembering correctly, we were on site either Monday or Tuesday that next week. it's our policy. We're not going to put an LOI in on a deal without having seen it, and without having the full weight of our firm's convictions behind our offer. And we made that very clear to the seller, that we need to see that before any further steps were taken. Fortunately, they were extremely open to that, and we were on site within 2 days and had our kind of initial due diligence, if you will, done by the end of that week. So,
did you have any limitations because of COVID as far as during that due diligence process and walking the units or anything?
No, so that became more of an issue. Well, wasn't necessarily an issue, but that became a topic of discussion during the actual due diligence period when we did our full unit walk, so 100% of the units, and our lease file audit. And we came to an agreement through our legal counsel and with the seller's legal counsel on a particular way to approach the unit walks, where there'd be limited people inside the unit at any particular time, to keep everyone safe. But at the end of the day, it didn't result in us, not being able to get into a significant amount of units. I think there's 70 units. I think we got in 68 of them. There were two particular clients, which obviously are residents, which we're obviously not going to argue if they don't feel comfortable with it. But for the most part, everyone was extremely open to the idea.
So let's dive into the due diligence process at this point. So you now have the broker that has reached out to you. You've submitted your LOI, waited the time for the deal to be awarded to you. You had this the PSA signed. Now you're in this due diligence process. What are some things that came up during the due diligence that might be interesting to talk about?
Yeah, so I think the biggest I'd say the most interesting aspect of this deal was from a deferred maintenance perspective. So when we were initially brought the deal, the broker had communicated to us that the seller was contemplating holding off on marketing the deal through a full marketing process due to a deferred maintenance issue that had to do with some condensation on the windows and improper airflow throughout the building that essentially created stagnant air throughout the hallway corridors and then a handful of the units. They had BH management on board as their property management team, as a construction management arm as well. And they had done a significant amount of due diligence on the issue and what it would cost to remediate and fix it. At the time, which we had been told would be somewhere in the ballpark of $150,000 to $200,000 issue. In an effort to make our offer more appealing, given that we were new and it was our first deal, we offered to the seller that we would take on that project. And it was not just risk, it was a calculated risk. The three of us each individually have significant relationships on the general contracting front with a variety of firms, and we have had some conversations with them about some ways to value engineer that fix and potentially bring our cost basis down. And we got to the point where we were comfortable enough that we could do it for significantly less than was being communicated to us. And so we felt comfortable taking on that project ourselves. And I really think that was probably one of the biggest leverage points in our offer to the seller. Outside of that, rest of due diligence was fairly straightforward. I mean, it was a property that is adaptive reuse warehouse project that was redeveloped in 2011. So for the most part, the systems, the unit finishes, amenity spaces, et cetera, were well maintained, up to date, pretty limited deferred maintenance outside of that one issue.
So let's talk about the business plan. What's the business plan on this property?
Sure. So we typically target, anywhere from 3 to 7 year holds. I'd say our base case scenario is a 5-year hold, which is a product of focusing on the value add and opportunistic space. So this particular product, like I mentioned, was redeveloped in 2011. Still had all original finishes from both a unit perspective and a common area perspective. Over that time from 2011 to when we acquired the property, Manchester saw some pretty significant gentrification. There are a handful of new developments that popped up around Perry Place, in addition to a solid amount of retail and nightlife and entertainment and cultural amenities. Our real value added proposition with this deal and what drew us to it in the first place was that it was our belief that the seller was extremely focused on their basis. When they initially bought it back in 2011, they came in far below market, so it was a great play for them as well. And at the same time, as part of their exit liquidity strategy and part of our upside, they hadn't touched the units or the amenity spaces, and there was a significant delta between our rents and newer product. And at the same time, it wasn't insurmountable given the bones of the property that we were buying. It's got vaulted ceilings, floor-to-ceiling windows, original hardwood flooring, extremely wide hallways, plenty of space for additional amenities. And so there's a very clear opportunity for us to come in and implement those upgrades and bridge that significant gap to top of the market, that existed when we were looking at the deal, while still remaining a bit of a value, alternative for the residents that want to live in Manchester.
So are you doing more are you focusing more on an amenity upgrade, or maybe doing more some of the interior units as well?
Yeah, so this one is a bit different than our typical strategy, which is primarily focused on a heavier unit renovation program. This one, particularly with the condition of the units, it really reverted back to a discussion on our end of return on costs. In other words, bang for your buck. These were, like I said, vaulted ceilings and good unit finishes. And while there was opportunity to go in and repaint it, do more modern colored countertops, paint colors, cabinetry, furniture, fixtures, etc. As a firm, we're typically targeting a 20% return on costs. And the real shortfall with the property in our mind was the amenity offering, specifically as it compared to the newer Class A comps in the market. And so, we've got a pretty heavy capital program in place, dedicated towards the amenity spaces. So the pool, for example, we're going to be updating the entire pool house, repainting it, creating an outdoor grilling area, rebranding the property, and then the common area spaces. An overarching theme for us was the general tenant base that is attracted to Manchester these days. Not to go off on too much of a tangent here, but you have downtown Richmond, where there's core downtown, and then an area called the Fan, and another area called Scott's Addition. And that's really where, over the last couple of years, the majority of your millennial and urban renters were living. It's subsequently gotten pretty overheated, and the rents are rapidly climbing. Manchester is in a strategically located market where it's right over the bridge from downtown Richmond. If you wanted to walk to downtown Richmond, you could, but offers a value alternative for some of those younger renters that still want to be able to walk or bike to work, but live in somewhat less gentrified area for the time being. Manchester is very interesting in terms of its cultural feel and vibe. I'm not sure about your familiarity with Richmond, but historically it was a very industrial town, and over time a lot of those old mills and warehouses have been redeveloped into some pretty unique products, not only in the multifamily space, but office, hotel, etc. And Manchester really captures that vibe. And fortunately, the three of us know a lot of people personally that live in Richmond, spend a lot of their time in Manchester, and there's just a lot of key fundamentals of that submarket that interested us, and I just want to make a bet there.
Sure. So let's move now to the financing side of things and talk to us about how you ended up financing this deal.
Sure. So we financed this as a standard agency through Freddie Mac loan. It was through the CBRE Mid-Atlantic Capital Markets team. So it was, for all intents and purposes, in-house with the broker that was selling us the deal. As a company, we're generally targeting a lower leverage point, generally in the 65 to 70% LTV range. Particularly now in the current environment with COVID going on, it's more accretive to the deals to be at that lower leverage point, particularly from a reserve requirement perspective. Fortunately, we were able to negotiate a full-term interest-only loan at 65%, and Freddie at the time, may still be doing it at 65%. Your reserve requirement for COVID is significantly reduced. I think for a standard conventional loan, it's anywhere from 9 to 18 months of principal, interest, tax, insurance, and replacement reserve. Because of the fact that we were at a 65% leverage and well in excess of the minimum debt service coverage ratio, our only reserve was a 6-month interest only escrow, which was non-self-liquidating and returned to us, subject to some debt service coverage testing. So it definitely helped the returns on the deal.
And what kind of interest rate did you get?
So this was actually the first deal that I worked on that was indexed off of SOFR, which was great for us. I mean, it's not too far off from LIBOR, but I think at the time we rate locked, SOFR was somewhere in the 15 bip range, something around there. And we had a 250 basis point spread over SOFR. So our all-in interest rate was in the 2.7, 2.8 range.
Did you end up buying a rate cap on it as well?
We did, yes. Yeah.
Okay. And what was the length of the term on this one? Obviously, it was probably amortized over 30. But was it a 5-year, 7-year, 10-year term?
Yes, we did a 7-year term, floating interest rate. And the reason we did that versus a 10-year or longer was just for some exit flexibility. Your prepayment is obviously way less prohibitive through that program versus a fixed rate when you're subject to yield maintenance or defeasance.
That was going to be my next question, was about the prepayment penalty. What kind of prepayment penalty was in play at this one?
Yeah, so assuming that we are, we hold it through our intended hold period, it would be 1% on exit.
Okay. And so does that 1% ever go away, or does it, or obviously once you get to the end of the term?
Yeah, I think it goes away within 3 months to loan maturity. I would have to go and look back at it, but that's pretty standard, where I think, if it was a 5-year loan, for example, after 57 months, it steps down from 1% to just par.
And on this one, it stays there for the
no, we have that.
Oh, okay.
Stepping down to par in the last 3 months. So, it's a bit of thread in the needle in terms of when we exit. We're not necessarily boxing ourselves into a particular date when we plan to dispose of the asset, but regardless, it's far more accretive to the deal than yield maintenance these days with where interest rates are.
What's the length of the projections right now of how long you're planning on holding the property? Because obviously there might not be an exact date, but what were the projections based off of?
It was 5-year hold. So generally it's based off of a few things. So I'd say one of the biggest determining factor is our value add program that we plan to implement. So we intend to, in some shape or form, address 100% of the units. There's a bit of a phased renovation with this one, so not every unit is the exact same. But during our due diligence process, went back, looked at the lease expiration schedule, average turnover within the submarket, et cetera, to understand what our typical renovation pace would look like. And then being able to complete that program, and then to, hopefully realize some of the market turnaround, specifically within Manchester, that we think is on the horizon here pretty shortly.
So on these 70 units, how long did you project that you would be able to renovate these units?
That was over a 2-year period.
So 24 months to get them renovated, and which seems very reasonable, even some extra cushion in there because of, the unknowns of what might happen over the next probably 6 to 9 months or so. So kudos to you for adding that extra cushion into it. What is, when you're actually doing, I'll just kind of go over to the investor side of things real quick. I want to kind of dive into some of the return metrics and stuff like that too. What were the projections that you were providing investors on this one as from a return level?
So from a return perspective, we're targeting mid to high. Generally, as a platform, we're targeting mid to high teens from a levered IRR perspective on value add deals. We've set. Fortunately, we're not a fund structure at this point, so we're not beholden to certain thresholds for our investors from a return perspective. But regardless, we have our own kind of self-imposed thresholds, obviously. And so, from a cash on cash perspective, we want to be out of the gates at least an 8%, hopefully averaging higher than that and getting into double digits towards the back end of the hold period. This deal met those. And, from a fundraising perspective, I think that was particularly helpful in today's environment. I mean, 2-3 years ago, the value add and opportunistic space, the standard returns in my mind were, high teens, and every capital partner you talk to said, hey, we're, targeting high teens, would like to touch 20 if we could. And now the new value add returns are closer to the mid-teens level. And so we felt like it was a good bet, and, it proved to be true. As evidenced by our fundraising, we had the deal fully committed within about a week and a half, just under 2 weeks. There's plenty of capital interested in a deal like this.
And how much was the equity raise on this one?
It was $5.5 million, just under $5.5 million.
Okay, and that included obviously all the CapEx dollars and stuff like that.
Yep, that's right.
Okay. And what did you do to go about raising the capital on this?
So obviously there's all of the bureaucracy that you have to go through in filing with the SEC and doing an official private placement memorandum, et cetera. And so we had our legal counsel assist us on that front to get all of our documents in order. But from an actual fundraising perspective, it was just hitting the phones as hard as we could for as long as it took. I think for that, 7 to 10 days there when we officially, went into fundraising mode, we were on the phone all day, every day with anyone who would listen to us. And fortunately, the investor base was very receptive to both, one, taking our calls, and two, the deal. The fundamentals for the deal were there, so it was bulletproof in our mind. From there, it's just a matter of getting their initial soft commitment and signing them up via subscription agreements, and getting everything in place logistically.
So obviously, you guys just started this company this year. I think you said
right.
May of 2020. Is that correct?
July.
So July of 2020. What did you do from July of 2020 to actually build your investor base, or did you kind of already have that going into it?
It was a mixture of both. So that was part of our general thesis with the three of us coming together as a company, was bringing our prior relationships and investor base to Fulton with us. But at the same time, yes, there was a extensive amount of pure, just unsolicited outreach to solicited and unsolicited outreach to high net worths and family offices in particular, that focus throughout the Mid-Atlantic and Southeast.
And did you set this one up as a Reg D 506 Charlie or Bravo?
Charlie.
Okay, good. Well, I always like to ask the question because you never know. So can you think of any other issues that maybe came up throughout the entire process that maybe we have not touched on that you think may be interesting for our listeners to talk about?
Let me think about that. So I can speak from the point of view of being a new firm, because that wasn't something that I had dealt with before prior to starting this. And I think I was, used to a certain time frame from being awarded the deal to closing, and the typical time frame everywhere in between. I think particularly on our end, getting the agencies comfortable with you, from a liquidity perspective, net worth perspective. Obviously, it doesn't matter what you've done in the past. If you're a new company, you have no track record to lean on. The agencies don't view it like that. So that was definitely a hurdle that we had to get around in terms of getting them as comfortable as possible in the time that we needed to hit our.
How did you do that?
A lot of conversations with them, honestly, and a lot of support materials that they requested, in terms of what our management program would look like, what our reporting would look like. There were requests to have some of our larger, investors on the phone at certain points. It was a whole bunch of different, avenues that they took, but they vetted us hard. Not gonna lie, it was not easy, but fortunately we were able to do it. And then, going forward, once you pass that initial vetting process with both Freddie and Fannie, it makes it all the much, more easier on every deal going forward. But that was not something that I anticipated taking as long as it did when we initially started out.
And you had mentioned you were about to say a few other things there too. So I think I kind of broke your stream of consciousness there.
Oh no, it's good. I think I lost my stream of consciousness as well. Don't worry about it.
Well, I'm gonna kind of end the podcast today with two kind of last questions, and I think I kind of know where these are gonna go, but I'll let you answer them in your words instead of mine.
Sure.
The first question is, what did you find that was easier during this entire process that maybe you thought was going to be a little bit more challenging?
I think, in my mind, probably investor confidence, honestly. We weren't naive to think that Charlie, Jack, and I are all 29 years old. we're not naive to think that everyone would immediately buy off on the three of us starting a company together and being able to execute at an institutional level. But I feel like we counteracted that with the quality of our materials, our pitches, the level of diligence that we're doing on these properties, and it was received really well. I think age played a lot less of a factor than I originally thought it would. If you know what you're talking about and you put together a compelling business strategy and investment plan, there are plenty of people out there that view it as a long-term strategic relationship, are willing to, it's not technically seed capital, but in a way it is. Mm-hmm. So that was definitely a nice surprise on our end.
So the final question here is kind of contrasting that. What did you find that was more challenging that maybe in the beginning you thought was going to be a little bit easier?
I have a feeling you were going to ask that. I'm trying to think about what's been harder. I mean, COVID definitely doesn't make anything easier. I'm in DC. My other two partners are in Charlotte and Raleigh. Albeit that's by design to have boots on the ground in all the markets we intend to invest in. It's not necessarily easy operating efficiently, when all three of your partners are in three separate locations. Fortunately, that was a steep learning curve, but one we overcame, and are in constant communication with each other via all the avenues of technology that we have nowadays. So it hasn't been too rough on us, but that's definitely something that posed an upfront issue in our ability to all be on there. Because for example, it means a lot for us and to a seller when you're looking at a potential property and all three of your partners are there, and they know that everyone has seen the property, everyone has sign off, and everyone has conviction in their offer. Having all three of us out of market or in separate markets doesn't necessarily make that easy. It requires a lot of time on the road and in the car and away from your families. But that's on the flip side, the beauty about having your own firm and operating an entrepreneurial environment is your success is directly tied to as hard as you want to work. So it's something that the three of us are willing to do. It's worked so far. So stay the course.
Well, Kyle, how can the listeners reach out to you if they have further questions for you about this acquisition or maybe a future one that you have coming up?
Sure. So our website, the email goes directly to me, actually. There's only three of us, so it's not like there's a whole IT department that all the messages are going through. Our website has a message board at the bottom that goes directly to us, and we read all of them. And we welcome the opportunity to speak with anyone that's interested.
Awesome. And what is that website?
www.fulton-street.com.
Awesome. Well, Kyle, I want to thank you so much for taking the time out of your schedule to be with us here today and sharing your experience that you had on this property. Looking forward to continuing to follow you as you continue to close more deals, and looking forward to having you in a future episode.
Yeah, thank you. I appreciate you having me on. We love your show. Best of luck to you.
Thank you so much. Appreciate it, Kyle.
All right. Have a good one.